Hello, and welcome back to another episode of Bank Nerd Corner, the resurgent Bank Nerd Corner, now that Kiah Haslett is a fellow creator here at Fintech Takes and the author of the wonderful Fintech Takes Banking newsletter, which has just started to publish, and I hope and trust that you are all reading it. I was delighted to have Kiah come back on the podcast. This one was pretty diverse. We covered a lot of different areas, and it was a lot more fun, I would say, than your typical Bank Nerd Corner episode. You might tune in for the discussion on federal preemption and the push and pull between banks, federal regulators, and state regulators to figure out who is regulating what and how difficult or easy that makes the lives of people who are trying to build products in this space. But you are likely to stay tuned into this podcast to hear Kiah Haslett answer a question that I have wanted to pin her down on for a while. What are tokenized deposits and why are they good? That and a whole bunch more on today's Bank Nerd Corner podcast featuring Kiah Haslett. Okay, Bank Nerd Corner is rolling. We are back in business. Kiah Haslett, creator of the Fintech Takes Banking newsletter, is here. Kiah, what's up?
Not much. Just had my first newsletter send, and I am getting ready to see you and some of our friends in a couple of different places around these United States.
That is 100% true. So let's hit those two topics in order before we get to the business of the day. Fintech Takes Banking, edition 1, the inaugural edition, the one that people are going to be trading rare copies of in the future and turning edition. Into NFTs.
The holographic
first edition, one. Yeah. It came out, it'll be a couple of weeks by the time folks listen to this. I'm sure everyone listening to this podcast has read it, but for those maybe who haven't gotten to it yet or been out on vacation or taking kids back to school, what was the first newsletter for the Fintech Takes Banking? What was it about?
So I decided to look at the comment letters that were submitted to a regulator's request for information or RFI. You and I have done this before. I love kind of looking at the different perspectives and viewpoints that are submitted to the regulator. And this one was of particular interest because it was the OCC asking OCC supervised banks about community bank digitalization, which I prefer digitization, and I wrote about that. I was really excited to read about what the community banks are going to tell the OCC, but that's not what happened. So that's not what I got to write about. This RFI, there's, famously 4,000 banks in the country. The OCC regulates 1,000 of them. 800 of them are thought to be community banks. 5 community banks wrote in, including one that is not regulated by the OCC. So I had to kind of pivot, and I did read their letters. I thought they had some interesting ideas. They certainly think about what's possible and what the regulator could do, I think, differently than how the regulator conceptualizes its work. But then I also kind of got a little existential, as I tend to do sometimes, and asked myself, what are we even doing here? Why did we even do this? Also, do you not know the answer to these questions? That I found myself being like, really? You really don't know how reliant community banks are on vendors? Or did you just need them all to tell you that? You can just figure that out?
Well, we're going to let you rant about that last point at the end of the podcast. But suffice it to say, a great start to the Fintech Takes Banking newsletter, which we will drop a link to subscribe to if you haven't already in the show notes. I'm sad that you didn't get to read 4,000 responses to the OCC's request, but or 800 responses. But at the same time, sometimes a lack of data is data. And so it was a very good piece. And as I teased last time we were on the podcast together, I've gotten a sneak peek of future editions of the newsletter as well. And it's going to get even nerdier. This was like Kiah not trying to scare people off with the first edition. but we're going to dispense with that pretty soon.
Right. I was told that you're not supposed to have accounting newsletters as your first newsletter. And so we did have to find just another thing to write about, but it's coming.
The really nerdy stuff is coming. And actually, accounting is not totally irrelevant to some of our conversations that we're going to have on the podcast. But before we get there, second point that you brought up, which I did also want to tease because we will be out on the road by the time folks listen to this. We are going to be together next week. We are going to be together in person the following week.
That's correct.
Where are some of the places that you are going to go?
So you're going to many more places. I don't envy you. I noticed you've got at least one conference that overlaps, and there's a very infamous Sex and the City episode where like I think one of the girls goes on 2 dates in one day and she like double books herself basically. Sure, and that's you. That's going to be you. I just want you to know you're going on 2 dates on that day when you are. Is it in the same city? Are your conferences in the same city at least? And you can just go to different hotels? Okay.
Yeah. So some of them are. So I'll run through my crazy schedule just because it's now it's apparently Sex in the City, which is now going to be the metaphor in my head as I'm walking around New York. But yes, next week I'm going to DC briefly, and then up to New York City, I guess, up to New York City. I don't know the East Coast geography. I live in Montana. It's its own like real country. We like to think of it that way. And then for New York, I will be there for 2 different events, Finovate and the Nova Credit Cash Flow Underwriting Summit. So expect open banking to come up a time or two over the course of those 2 days. And then off to Austin, Texas, where you will also be. What are we doing in Austin, Kiah Haslett?
We are doing our employer work week as Upstarts, where we have some of our partners, our brand partners.
Upfronts, Kiah.
Upfronts. Okay. Sorry, I'm a new employee. This is my first. I'm going to be on stage talking about this, though. So I'm going to learn what it's called.
Just on your hand. That's what I do, on my hand. Yep.
And so that's really exciting. And I'll be able to meet many of my coworkers for the first time.
That is so true. Good. That is so true. Yes, we are a remote first company. And so while everyone knows the legend Kiah Haslett at Workweek, most of them have not had the pleasure of meeting you. So we'll all get to be together. You're going to be on stage, at Upfronts, presenting to sponsors, talking about all the great things that we do. It should be a lot of fun. It was a lot of fun last time. And Workweek is a delightful company, as you're finding out. So that'll be great. And then a quick break to, I guess, get back home.
Yeah, we got to unpack, do the laundry, repack.
Yeah.
And then go
back out on the road
to MX.
Yes. So you are coming out to the Rocky Mountains this time. So a little further afield for you, closer for me. And it will be the Money Experience Summit that MX puts on. Kiah, are you presenting? Are you doing a panel?
I'm moderating a panel on open banking, and it's going to be with several aggregators. And at first I thought it would be more competition among the aggregators, but actually it will be like David and Goliath talking about kind of where we are in open banking and who the adversaries are, I guess. It's probably not the best way to phrase it, but that's how I'm thinking about it.
She might not ask the question like that on stage, but you will be thinking in those terms. I am also moderating a panel at Money Experience Summit. Mine is unusually a panel about generational differences, which I've never done before, but it's a fun one because the panelists are all people of different generations. So I am both the moderator and the millennial. So I am literally sitting in the middle of the group of panelists because I am the moderator and the like sandwich generation right in the middle. And then on one hand, we're going to have a baby boomer who's worked in financial services, as well as a Gen X, I think, mother of someone who works in fintech, which should be really fun. And then on my other side, we will have a Gen Z college student who is going to be joining us, and then a Gen Alpha high school student who's going to be joining us. And so we are going to learn all about the generational differences and how people treat their money. And it'll be unlike any other panel I've ever moderated. So I'm looking forward to that.
That's cool.
My question for you, Kiah, is one of the things I want to do for that panel is ask like, okay, who's heard of this, right? To kind of test out like how money changes and like the language we use around money evolves as time passes. So like on the one hand, like, do you know what a traveler's check is?
Yeah. Yes.
I know what it is.
And like, are you going to ask, have they ever used one? Like, would you
I was thinking about like,
or like,
have you ever, have you ever written a check?
Oh my God. Have you ever? Oh, that's so funny.
Have you ever like, right? I think that would be kind of fun. And then, but my question for you, Kiah, because I'm a millennial, but I'm like an old millennial, is what would be some good things to ask that would trip up the old people on the panel? Like, have you ever, do you know what fart coin is? Maybe it would be a good one.
Like, I remember, and I assume that we've kind of moved past this, but telling my parents about like Lyft and Uber. So I assume like the boomers have figured out how to use Lyft and Uber.
My understanding is that,
or like Zelle and PayPal.
Yes. I think they know what that is. They probably know what Cash App is. Yeah.
Do you think they know what Cash App is?
I don't know. Maybe I have to ask, like, have you ever Cash Apped someone? That could be a question we could ask. Have you ever bought an NFT? Was that too, like, brief a period in the sun
I
for
think
most
NFTs
people to
are
do?
really, they were very internet brain. And I just also, like, you can't assume the demographics of an internet brain.
Right. That's a great point, right? Like, just because this kid is in high school doesn't mean that he spends all his time on Twitter. In fact, I hope he doesn't, right? Like, he might not know what an NFT is.
Oh gosh, I'm going to be thinking about what financial products or what financial technology a boomer wouldn't know.
Yeah, that's what I need to find out.
Yeah, that is really interesting.
What's the thing that a 16-year-old would know, a money-related term or product or whatever,
so this is like,
that someone in their 60s
this is
would know, 70s?
A dumb anecdote. Okay,
yeah.
So, you know, Alex, in some states in the United States, marijuana is legal.
I've heard that. That's
okay.
Crazy,
I was at a conference once, and someone I would describe as a boomer or older was probably in a state where weed wasn't legal, was in a presentation about how a fintech could help banks service marijuana businesses or marijuana adjacent businesses, because there are some issues with payment acceptance, right?
Yeah.
And the person, like, he's in this panel clearly to learn, but kind of doesn't know enough. He's even to like understand the problem. And so this person asked, like, well, why can't you run cards? And then so the guy explained it. And then he was like, well, why can't you do checks? And I was like, oh, like, do you what don't you understand about how money moves in the United States? Like, and where can we like plug this gap? But like,
it's
so part of me is like, is that a boomer?
Just use a check. Just get out the old checkbook. I mean, checks are probably the best example, I guess, of one where I am positive. I am willing to bet a lot of money right now that my kids will never write a check. Like, I think by the time they get anywhere close to having to like deal with money themselves, not just like from mom and dad, but like actually have to like deal with their own money. I just don't think that they're going to have to do it. I mean, checks are probably the best example of something that's really going to divide the generations, the way that like payphones were a generation ago, where it's like you either like experienced it or you didn't.
You can't tell me how a beeper works. Like, you can list it out, and it's just not going to make sense in my brain as like. And so how is anyone communicating?
Well, no, I mean, and it's weird because I remember my dad like had a beeper, but I don't remember how it worked or why or like how you used it. It's just like, it's a thing that exists in popular culture, but it doesn't like feel like a thing that happened in my life, even though technically it did. So I think checks might be kind of similar. Kiah, we've rambled enough about this topic, although I do want you to think more about other things I can ask the old folks on my panel, as well as the young kids on my panel, as I sit right in the middle. Can we talk banking things?
Sure. I think we should.
I think we should too, especially given that relatively soon this is going to be your podcast, not my podcast, and I can't dictate terms anymore. Like,
you know, when it's my podcast, we're going to have an outline done a week in advance and not less than 12 hours.
Oh, stop. You had plenty of time. I don't like you to over prepare, Kiah. I like you to
Why wouldn't I want to know what I'm talking about? Why wouldn't I?
Just talk. Talk. That's what we do here on Alex Johnson's version of Bank Nerd Corner. We'll see how that evolves over time. All right, Kiah, the first story is yours.
Yeah. So Reuters reported this week that U.S. banks have started lobbying the OCC, which is the national bank regulator, to outline or to make certain rules, a uniform set of rules that would include how they can make money, how they can issue bonds, or provide investment banking services, or assess AML risks. And the impact of that would be it would curb state powers over these banks' operations. The sources said that it would make it easier for lenders to operate, and that they saw, I guess, certain states as having the ability to disrupt large bank operations with, in this article, they say is debanking. I don't know how much I believe that, but I can actually believe there's maybe some other things that different states are doing. Maybe interest rate caps, maybe like certain types of practices or banking pressure about certain types of customers. But it's really actually kind of furthering this fight that we've seen in the last couple of years about this idea of federal preemption, which is that if there is a federal rule, it would override or preempt all the state rules as it applies to that area or that activity. And it seems like these banks are trying to get the regulator to issue rules so that the rules around lending would preempt lending rules that different states issue. And so I thought that was very interesting. And I think it's like the rumblings of like a volcano, that's kind of like some pressure is building in this area.
So I have felt that pressure too. And I will say that, it's funny, right? Like, the longer you spend studying this industry, the more you get a sense of like the things that exist on the surface versus the things that exist under the surface, to use your volcano analogy.
Yeah, or like a fault line or icebergs.
Yeah. There's a geological component to this. And a lot of that has to do with basically this sort of tussle between the states and the federal government over regulating banking, really, right? And of course, this also references our friends at the Conference of State Bank Supervisors, CSBS, which is the sort of group that coordinates the interests of all of the state banking regulators. But also, you even see this between federal banking regulators, right? Like, they'll fight with each other to a degree to kind of steal a set of institutions, and it's like, no, we want them to be chartered with us, not with you. We want to be their primary regulator. So there's always this kind of constant tussle. And I would say that largely due to the current administration and the sort of chaos that has been sort of thrown into the regulatory sphere, it sort of feels like everyone is kind of fighting for territory right now, right? And this story is obviously banks sort of encouraging the OCC to fight for its territory and to maybe even expand its territory. Because to your point, the OCC, I would say, and push back if you disagree with this at all, but in some senses, they're kind of like the primary thorn in the side of state banking regulators, right? Because the OCC can offer a different versions of a national charter versus having to get state charters, even if you're going to be ultimately regulated by the Fed or regulated by the FDIC. And to me, there is a lot of tension between those two. And, you see certain areas, this is how I read the Reuters article anyway, is you see certain areas like price caps, interest rate, where that's a very well-legislated, well-challenged, well sort of understood corner of federal preemption. But I sort of read the Reuters article as saying, look, there's a whole bunch of other areas that apply to federal preemption or that are less sort of clear or less well sort of figured out. And it's those areas where states are, from the perspective of these banks, making the banks' lives harder, and where they want the OCC to kind of essentially push the state regulators away from their operations a bit more.
Like one example is earned wage access, and one would probably be buy now, pay later, or like the fees, like some of the fees, and if they're annualized out. And we've seen some states make certain decisions about those products. And I do I do understand that when banking can occur outside of geographic boundaries because the internet exists, or you bring up interest rate caps, and I was just talking to someone this week about the Supreme Court case that in the 70s that was regarding interest rate caps. And the reason why that's kind of settled law is because once the Supreme Court sided on the bank, Congress went in and made a law. And that's why why it's more settled than what we see today. And so I do think it's really interesting how we've managed these conflicts in the past and how they arose, and then how today technology is really making this kind of whack-a-mole approach of Illinois might want to do it one way and California does it another way, how that's not tenable. And that if you believe you have a national regulator that might be more favorable to you, you might see this as a good time for that regulator to expand or be more specific, I guess, with these rules, and then make them into preemptive rules.
Yeah, I mean, it's so funny, right? Because depending on what you want as a regulated entity, you'll sort of vacillate between cheering your regulator on to do more, right? To make your life easier, versus telling your regulator to back off and leave this to you. And I find this tension kind of funny, because I'll just use one example. The CFPB hasn't had a lot of friends in any corner of industry for the last little bit. And I think in a lot of ways that sort of explains how we ended up where we are, with the CFPB somewhat defanged and just sort of sitting there not doing much unless they're weighing in on open banking or rescuing the Synapse victims. But apart from that, really not doing much. That is in a lot of ways an outcome that the industry was kind of pushing towards by just not in any way being supportive of the CFPB, constantly suing the CFPB. They wanted the CFPB to be defanged. Fine, you don't like the CFPB. That makes sense to me. Well, guess what happens, though, when you weaken the CFPB? All the states freak out and go, okay, if the CFPB is not going to do this, we have to step up and do this more. We have to be more proactive. We have to be more assertive in protecting our citizens if the CFPB isn't going to do that. And so it's this very strange tension where, if I can kind of put on the bank hat for a second, it's what we would ideally is for the CFPB, who we don't like, who's always bothering us about stuff, to go away. But we would also like the states who will only back off in the assurance that they have a strong federal regulator who's watching out for their customers. We would also like them to go away and to not step into that void. You kind of can't have both things. And so I find it interesting how those things kind of get pushed and pulled back away from each other. The other thing that came up in this discussion I was having with somebody this week was kind of touching on your point about debanking. I have heard that one of the reasons that Fed master accounts are so prized is that Fed master accounts are one of those things where it's difficult to get, and you obviously have to qualify at one of the different tiers, and then you have to go through an assessment process and be approved for a master account. But once you get one, it's much harder for you as a non-bank or a payment company or a payroll company or whatever to then be debanked in the sense of cut off from those rails, right? And so I also wonder if we might see more of a push towards strategies where it's we just want to get whatever level of assurance we can, that we can have a set of rules or access to a certain set of tools or infrastructure that kind of can't be taken away from us, or where the rules of our little game that we have can't change. And I feel in some ways it's sort of a reaction to the the more volatile nature of federal regulation recently, where it's like, you can't have a charter, you can't have a charter, you can't have a FedMaster account, you can't have a FedMaster account. Like, businesses can't plan and operate with that level of volatility. And so I feel like in some ways it's a reaction to that as well.
Yeah. Yeah. And I think that it's interesting because I would say federal preemption has always been inherent in the dual banking system. And it just feels like we're having more fights about it now. And I will have to write about it eventually, and I'm going to do my best to make it very exciting. But
federal preemption is super exciting. I don't know what anyone is talking about.
But I do also think that one reason why preemption fights are happening in part is that many fintechs have to, like, if they don't have a bank partner or they don't apply for a bank charter, they have to do the money transmitter licenses, and that is state by state. And so we just happen to have more products that are kind of covered by the licensing system. And so there's tension there between these, just what is the way we can do this thing, and what makes the most sense, and what's the most cohesive, and what's most, to your point, stable.
Mm-hmm. Well, and mentioning stable, and we'll probably touch on a few different things here, but crypto is just a huge rock that got thrown into the middle of this pond on a whole bunch of different levels, right? Because now we have crypto companies getting national trust bank charters to try to get access to some of these systems or some of these rails without necessarily becoming bank holding companies. We have Section 16D of the Genius Act, which allows for state-chartered non-depository institutions with stablecoin subsidiaries to bypass the requirement to have money transmission licenses in other states with CSBS hates. So, like, the crypto stuff, whenever you throw a new technology or a new charter type or a new regulatory framework into the middle of the pond, everyone kind of freaks out and goes, okay, how do we make sure this is the best possible version of it? So I think a lot of the tension we're feeling is also due to crypto being like, hey, we'd like to have our own seat at this table. And it's like, I got a great chuckle out of the crypto lobby's response to the community banks and the state banking regulators' complaints about Section 16D, when they were like, well, it would just be totally unreasonable to ask us to get licensed in all 50 states to operate. Can you imagine? And like, in my head, I was hearing every fintech company going, yeah, man, like, welcome to the world. It sucks here, it's so funny how crypto comes to discover these things and they're like, oh no, we
just reinventing finance, just running into all the same walls.
They're like the dual system we have in the US. Like, oh, that sounds horrible. I can't possibly imagine. So, long story short, I do agree. I think we'll see this area continue to gain more momentum and pressure under the surface. Kiah, can I share a story with you that I'm obsessed with? Okay. It's not really a banking story, but I do think that here on Bank Nerd Corner, you have established a tradition of caring a great deal about dumb fraud, shall we say? And like, the dumber the fraud is, the better. And I have a really dumb fraud story, which is a fintech story, but is also a basketball story. And I love basketball and the NBA. So are you ready for it?
Yeah.
Okay. So Kawhi Leonard, who is a basketball player who plays for the Los Angeles Clippers, allegedly received a lucrative no-work contract from a now bankrupt company that was in the environmental sustainability as a service and fintech space that folks listening to this podcast may know, Aspiration. And that the franchise owner of the Los Angeles Clippers, Steve Ballmer, arranged this lucrative no-work contract for Kawhi Leonard so that he could be paid more money without it counting against his NBA salary, which is capped to ensure an even level of competition in the NBA. So,
no, that's awesome.
Kiah, is it not just the best? I love everything about this story, all the way up to Pablo Torre, who's an investigative journalist who focuses on sports, who discovered this by looking through the creditors in the bankruptcy of Aspiration and found a company connected, an LLC connected to Kawhi Leonard, where he got paid this money. And, there's so many great parts to this story.
Yeah.
But I think my favorite part of this story, and Kiah, we got to get into this line of work, honestly, is Kawhi Leonard being paid by Aspiration. The reported details of the contract are $24 million in cash spread out over quarterly payments for 4 years, which, if you read the bankruptcy filings, which I did because I just got sucked into the story last night, suggests that he got paid everything but $7 million of that $24 million. So he actually got quite a bit of it out of this company before they went bankrupt, as well as $20 million in equity in this company, which obviously went to zero. So he didn't get that. And that nearly $50 million, two things about that. One, it is almost exactly the same amount of money that Steve Ballmer, the owner of the Clippers, invested in Aspiration about a year before the deal that they struck with Kawhi Leonard. And two, that Kawhi Leonard had a clause in that contract with Aspiration that basically allowed him, if he didn't agree with the mission or didn't want to support the company, could just collect the money without doing anything. He didn't have to do any commercials. Yeah. He didn't have to tweet about Aspiration. He literally just got to collect, what would it be? $17 million in cash over a 2-year period before Aspiration, which I will say is one of the sketchier fintech companies I've ever come across. And I was writing about it back in 2021 when it was still being treated as a serious company as potentially being a scam. This is one of the most interesting tie-ups ever, I think, between a fintech company and a sports star, which is saying something because there's actually a lot of overlap in sponsorships and other things between the NBA and fintech. Kiah, what do you think about this?
Wait, okay. What's the crime here?
What's the crime? That's a great question. That is a great question. So, on the one hand, there really is no crime here.
Yeah, this is harmless.
Right, it is the definition of no one got hurt. No one got hurt. Literally no one got hurt. There's no victims. Everyone is totally fine.
Everyone who invested in Aspiration deserved that.
Right. Well, they really did. They really did. And I have no problems feeling not bad for them at all. The only problem is the other 29 people besides Steve Ballmer who own NBA teams are very mad about this. Because
some of us are working smarter, not harder out here. Come on.
The thing that's funny about it is
you can't move money around.
Well, so it's funny because, and I hadn't really realized this until I listened to some analysis of this news on the NBA side, because I was like, is this really that big a deal? The only reason that everyone else cares about it in the NBA circles is Steve Ballmer is about 100 times richer than all the other rich people who own NBA teams, which I didn't really realize. I kind of thought they're all billionaires. It's all the same. No, Steve Ballmer is like Jaws, and the rest of them are like minnows compared to him. And so I think what's happening here is all of those other owners are already afraid of Steve Ballmer and his massive amount of wealth and his ability to just buy whatever he wants and kind of shove them aside. And they maybe will want to use this story as an opportunity to sort of punish Steve Ballmer for using his wealth in anti-competitive ways in the context of the NBA and the rules it sets for itself, not any actual laws that have been broken.
Yeah, I think one of the issues here is I understand how a price cap works and why you have one and how they're structured. And also I understand that this is not part of his official duties. This is not part of his work as an athlete. This is not part of Leonard's work of being a basketball player. And
also just to note on that one, just for whatever it's worth, Kawhi Leonard is the most boring star athlete in basketball by a country. He's like a robot. He has no facial expressions. He's not interesting. Yeah. So the idea that you would want to hire him as a spokesperson is kind of stupid because he'd be a terrible spokesperson. his Twitter account, no one would follow it because he doesn't even use it. Like some star athletes are also really entertaining, like individuals and personalities, and you'd be like, oh, I kind of get it. This one, no.
So is there anything stopping like Steve Ballmer from like adopting Kawhi Leonard as his son and giving him $50 million? Where are we going to kind of cut off the money transfer? Like the reason why I want to give you money is like, I just like you.
Sure.
Like, you know, I understand that like the rules have to exist, but when we create rules and boundaries, we obviously things are in the scope of the rule and they are outside of the scope of the rule. And to me, I get that like they don't like this, not because maybe it's illegal. Maybe it says like, if you have an endorsement, the person has to do work, but like, okay, like he could have just like
is a clause in the contract where it's like, it's something to the effect, because apparently there are other celebrities who got pulled into the Aspiration vortex of stupidity. Like Robert Downey Jr. Was like a spokesperson for Aspiration, but he did a couple like little commercials or videos or whatever. And so like, even though he probably got way overpaid for those, it was money for work. Whereas I think the problem with the Kawhi thing is A, his boss invested in this company, and B, he didn't do any work for the $17 million that he collected. The other thing, Kiah, that this reminds me of, and this is kind of tying back to fintech for a second. I come from a simpler time. And in the simpler time I come from, there were more sort of clear lines between companies in terms of the role they played with each other, right? So like, if you were a customer of a company, you weren't also an investor in that company. Or if you were a supplier to a company, they weren't also an investor in you. Like, it was like, you sort of like stayed in your own lane to a degree. And I feel like today, there's a very common strategy, which I sort of think of as like entanglement, is sort of how it's like quantum entanglement in my brain, where it's like, hey, we want this company to partner with us. We want them to buy our services from us. We want them to promote us. One of the best ways to align our interests with that company and get them to do those things would be for them to be an investor in us so that they have a stake in making sure that everything goes well for us. Very like logical and sound business strategy. And the fintech company that uses this the best by far is Built, right? So like Wells Fargo was an investor in Built. And coincidentally, Wells Fargo signed probably one of the worst deals in the history of the co-brand credit card space with Built, and lost a ton of money on it and had to parachute their way out of it, which they're doing right now. I don't think those same things happen if they're not also an investor in Built. And so I wonder if one of the like big lessons coming out of all of this is maybe we need like less entangled relationships where like, if this is a sponsor of your NBA team, you can't also, even though you're super rich and can throw money around, invest in that company. Like maybe we need to have some lines drawn between these things.
What regulator would make that rule, Alex?
So this is the problem. This is the problem. This is the problem.
I'm used to stop me. You know what I mean?
So here, can I tell you something? Just on, so this is like back in 2024 world, not 2025. But like, what if in 2024, I went to Rohit Chopra and I was like, look, NBA teams are large participants in our industry. And you need to open up an investigation into Steve Ballmer and the Clippers. You know what another example of this is actually, and I wrote about this, another example is FTX, our favorite crypto exchange, which was the stadium sponsor for the Miami Heat. I'm shocked that like Sam Bankman-Fried didn't try to do this exact thing with one of the players on the Heat. Like it's sitting right there. He could have given him tokens in different cryptocurrencies. Like there's so much room to run here. And I think that when a Democratic CFPB returns, this should be a top priority for them.
Yeah. I mean, when I asked you what the crime was, I was surprised. I was like, is he going to say money laundering? Because I think Steve Ballmer can probably spend Steve Ballmer's money how he wants. And if it needs to take a couple of pit stops through some shell companies, and a no work contract, like more power to him.
Yeah.
But like commonly, this is kind of how money laundering happens.
It looks like money laundering.
Yeah,
it feels
I don't
like money
know.
Laundering.
Like, the other thing too is like the NBA people who, the other owners who are poor, still very rich, but not as rich as Steve Ballmer. Yeah, basically paupers.
Yeah.
The person who needs to be enforcing these rules is the commissioner. Yes. And, you would just hope that like either the commissioner says like, yeah, you can do it, or no, you can't. And the other thing too is like, I remember the book Free Food for Millionaires about how like people who make
they love free stuff.
Money, they love free stuff, and they like, and how they need more money. It's like, but and I'm just, it's hard for me to be like, God, why are we giving these rich people more money?
Well, I feel that way about the Kawhi Leonard thing. Is it's like, look, like this is cool and everything, but like, did you really need this $50 million? Like, great, and that's fine. But like by that point in his career, he had already made a lot of money. And like not Steve Ballmer money, but he made a lot of money. I feel the same way. It's just like, and this is why it's the best kind of fraud story, is literally no one got hurt. Rich people did silly things that are going to get punished by other rich people because those rich people are mad at them. Like, it's the best kind of fraud story.
Yeah.
It also perfectly aligns my interests, which are the National Basketball Association and sketchy fintech companies. So it's perfect for me. Kiah, I'll be your like reporter who's just on the story. And if there's any developments, I'll be sure to bring it back to Bank Nerd Corner.
I will say that one reason why you should subscribe to my newsletter is I am trying to tastefully work in or marry my interests of true crime and banking. And one of them is going to be a story that looks at how insider abuse and fraud can contribute to bank failure. And then I'm going to do a series on iconic bank failures, and which often involve fraud, but it will be funny.
Yes. Funny is the key, because if it's not funny, it's sad, and sad is like not so good, and that's where the tasteful thing comes in. But like, I'm with you. A lot of the stuff is really funny, and I am looking forward to covering more of these stories, including ones that are more directly related to banks. So, Kiah,
speaking of fraud,
speaking of fraud, we have a couple of last topics to hit. I'm not going to let you skip out on our last topic like you did last time, but before we get there, briefly, we should talk a little bit about mortgage fraud, I guess.
Question mark?
Is that what it's about?
Okay,
What's
Alex, I mean, I'm actually worried about this story, because if I have two homes and I split my time between them, or if I have more than two homes and I split my time between three of them, which one is my primary residence? And which ones am I allowed to rent out? And also, what mortgage interest rate should I get on these properties? And I'm worried for myself, because I did not realize I could be fired for cause, because this was seen, because like having applied for a mortgage in the years 2020 and 2022, the head of the Federal Housing Finance Agency might go dig up my paperwork and fact check me, which is happening to Fed Governor Lisa Cook, who was dismissed. Trump is trying to dismiss her from her job as a Fed governor in late August for this reason. And now it has made me concerned about my personal documentation for my multiple homes.
That is a very reasonable concern, Kiah. And I think it's important, actually, because I think you're well on your way to being in a position to get nominated to serve on the Fed specifically. Right, and so I want you to
there might be an opening. I just want to make sure all my paperwork's buttoned up before, that nomination comes in.
I know. It really made me think about a lot of the things that I might not be qualified for now, because, I've got 3 or 4 homes, and, I don't live in them all the time. And I honestly don't even remember what I put on the paperwork at the time. So, all right, we're joking about this. This is one of those ones where like you have to try pretty hard to find the humor, because there's another version of this, which is like democracy collapsing. But let's just talk.
And the loss of Fed independence, like
global economy, like this will be great. So you put a bunch of notes in our outline, which I appreciate. I think you hit the high notes, right? In terms of, obviously, this is in reference to Lisa Cook, as you mentioned. She is currently fighting her dismissal by President Trump for cause. I believe she's quoted as saying, I will continue to carry out my duties to help the American economy as I've been doing since 2022. I guess, Kiah, there's a couple components to this that I want to get your quick take on. The first is the Bill Pulte side of the whole thing. And I've talked about him on this podcast. I've talked about him in other podcasts, kind of obsessed with his Twitter account because he uses Twitter more than any person I've ever seen. In fact, so much so that Elizabeth Warren asked him questions about his Twitter usage, like from the perspective of, do you have time to get your job done? You're on Twitter so much. I think in this administration, the use of Twitter is sort of seen as a part of the job. And the thing that I'm curious about here is, setting aside how real or not real the violation that's been alleged here is, isn't it kind of strange to have the head of the FHA sort of doing a dragnet through old paperwork looking for specific people's information to see if there's any problems? Like, that's on a procedural level, that doesn't seem quite right to me, does it?
Yeah. So I think one word you could, or one phrase you could use to describe it, is a witch hunt. Sure. Adam Levitin, who is a Georgetown University professor, wrote that this search seems like it came from almost a hit list. Sure. And that he is using his position and he's using the access that he has to basically find dirt. Yeah. And I think it's actually really important because Levitin, in his post about this, said that the evidence that Pulte has produced might qualify for exclusion from the legal proceedings, because he called it fruit of the poisonous tree, which is that
that's a legal thing I actually know from television.
Which is that evidence that has been obtained in an illegal search is thought of as being tainted and should not be part of legal proceedings because it wasn't obtained in ways that are legally defensible. And I think that we should be very, we should have a lot of questions about not just what the paperwork is, but what this paperwork was access to, what kind of privacy protections she might have, what needed to, I'm trying to think, if a bank thought that you were committing mortgage fraud, how would a bank communicate that to me and ask me before filing charges or before taking my home or before garnishing my wages? What would a bank have to ask me to start the due diligence process, the legal diligence process, to make sure that the bank isn't violating any of my privacy protections? Or if the bank wants to say that I lied, how is the bank making sure that, how has the bank asked for the truth? Does that make sense?
It makes total sense. Well, it's and ultimately this comes back to motivation, which is one of the things that drives me crazy a lot about the coverage in the news. And Adam Levitin's done a great job of sort of framing out some of these points that are important, but kind of keep getting missed in these stories, because the stories I'm reading are all well, here's what has been alleged to happen. Here's here are the charges. Here's, the definition of cause, which is very, in this case, vague and unspecified. And they're sort of stepping past the earlier point, which is why did this happen in the first place and what was the motivation behind it? And to use your bank example, if your ex-boyfriend who worked at the bank was the one who started the process of looking into whether you falsified your mortgage documentation, I would have questions about is this a good process that led to this outcome?
Right. Should this person be involved in any of this? And
right. Should this have ever started in the first place? Right. And so I think that that's a very fair line of inquiry and criticism. The second question, which I guess is the one that's going to be litigated by the courts, maybe rising all the way up to the Supreme Court, depending on how this goes, is, does this rise to the level of something you can fire someone for cause for? Neither of us are lawyers, so we probably can't get too deeply into that argument. But I will say the one thing that strikes me as interesting on that is this is something that's totally disconnected from her service at the Fed, right? This happened before she was appointed. It's in no way related to her duties at the Fed. I guess in the sense that she's an economist and she works at the Federal Reserve, and the Federal Reserve touches monetary policy. It's sort of loosely related, but it really is in no way directly connected to her conduct on the job at the Fed. And so it does seem, I guess, flimsy from that perspective. And again, like you have to interpret this in the context of what we know the administration's goals are, which is not, as much as Bill Pulte tweets about it, just to like rigorously root out all mortgage fraud.
Yeah, I mean, the other thing too is like, and not to buy the administration's argument, but like also what's secure here? Like if she was like, oh, okay, sorry, I like split my time between one, but I guess on my second house, that's not my, like that I spend like less than 50% of my time in, should I just pay a higher interest rate? Do you want me to pay back pay interest or like the back pay interest? Like that would, that would cure the fraud, right? Like that would, or whatever.
Well, it totally would. Well, and then the other thing is a lot of fraud is defined by intent too, right? And so like, I mean, you and I are humans. Everyone listening to this are also humans. Like we make mistakes. Like I've screwed up paperwork 1,000 times. Like a lot of times with these types of things, if you want to define it as fraud, you have to be able to show an intent to commit fraud, not just I checked the wrong box. So to your point, even if she made a mistake and checked the wrong box, that doesn't automatically equal fraud, which by itself does not automatically equal cause for removing her from this post. So it seems like a chain of logic where there's some possibilities to poke holes or just to fix the problem in a different way, to your point.
Yeah, and I mean, far be it for me to point out the irony that in 2022, Trump and his real estate firm and his sons were convicted of a type of real estate fraud that involved inflating the value of the assets so they could get better rates or financing from their financial partners. Importantly, this conviction has been upheld by the appeals court, but the fine that Trump was assessed was lowered or overturned. But it's interesting because, like, I am right now looking at insider abuse and material fraud at financial institutions, and overvaluing assets is a very, very common type of fraud that shows up, that has showed like this type of fraud, not just overvaluing assets, but fraud perpetuated by insiders, contributes to about 40% of all bank failures between 1985 and 2015. It's a very, very common type of fraud. And you can like see it. You can find this fraud before a bank fails. I did not actually come across the harm that is caused by someone filling out 2 properties as their primary and then getting slightly lower interest rates. So I think there's I kind of think that like the fish rots from the head. And so Bill Pulte, who is so concerned about the integrity of the Federal Reserve, should maybe, have that same standard for everyone in the administration, in these agencies. And failing to do that, to your point, really weakens that standard being held to any one person.
I very much agree. And again, like we're sort of dancing around the core thing. And it's so funny, right? Like I really hate to pretend that I'm stupid when I read these stories, right? And it's like, a lot of them do a good job.
The thing we're not saying.
The thing we're not saying, right? Which is that what we know to be true, because he's said it, is that President Trump wants to exert more control over the Federal Reserve, which structurally, legally, he's not supposed to be able to do. And you just can't divorce that obvious goal and intent from all of these other things.
Right.
And, I think the only other thought I have on this story, and again, we'll see how it develops, is I've been pretty, I don't know if the word alarmed is the right word, but like I've been pretty surprised at how calm the market has been about this.
Oh, right.
Yeah, because it's like really like, that was always the sort of like rationale, right? Like when the president was going around and was getting rid of other independent members of different commissions and like regulatory agencies, it actually made its way all the way to the Supreme Court. And the Supreme Court essentially had this really bizarre ruling where they said the president is allowed to fire independent agency directors or commissioners unless it's the Federal Reserve. And all the lawyers on Twitter were like, that's not how the law works. You can't like draw these weird distinctions. But the reason that the Supreme Court did that was there's generally a recognition on the part of serious adults who run companies or who run investment banks or who sit on the Supreme Court to the independence of the Fed specifically and its importance to the global economy. The fact that these things are happening and yet the economy is relatively like calm about it and the market is relatively calm about it, I don't know, Kiah. I mean, it kind of suggests to me that President Trump might be kind of wearing us down a bit. In terms
they
of,
call
like,
it the Overton window, right? Our Overton window is shifting. You can see it in real time. Yeah,
it's like it's happening by degrees. And
it happens
so,
way faster than you think, too.
Yeah, and then so like these things happen, and you're like, well, but like you would never do this, Like, I mean, it's just I feel like the degree to which we are becoming accustomed to things that would have been completely out of bounds not that long ago. That's the other kind of meta point with this story that is jumping out to me as being.
Well, I also think and it's funny because remember like when Trump was talking a bunch of shit about Powell the first time, the market sold off a lot, and he ended up like verbally backing off from that. Mm-hmm. And then they started the specious headquarter renovation, and that kind of fizzled out. I don't know if it was like
Bill
the
Pulte
video
right there too. Yeah.
And then they kind of moved on to this third thing, and this one seems kind of sticky. It just feels like I feel like I don't know if I just think people are buying the argument, the like mortgage fraud argument, and so they're like, well, she was no angel, which we like talk about.
And mortgage fraud is this goes back to your earlier point. It's such a weird one because it's like just in terms of the emotional impact, like if someone says, hey, they committed mortgage fraud, I'd be like, okay, so like some banks got slightly lower interest rates than the others should have gotten.
Victims, they stole money from the banks.
Right. Like it's not a real great everyman kind of argument, I wouldn't think. And so
the amount of people who went to jail for the robo-signing mortgage frauds, the for cause of that versus people who lost their house
totally
part of it. Like you can't make me see this as a crime. Really,
it's tough.
At the very least, like if she said tomorrow, okay, I will pay back.
I checked the wrong box.
As a
result, I let's just say I saved $50,000 on interest that I should have paid.
And more, like tomorrow this could be fixed, and it's like It's not even a crime. It's like barely a misunderstanding. I don't know. Like, I don't know. And the other thing too is like, why is the FHFA doing this instead of the banks who are the victims?
It's a great one. Yeah, like the FHFA, apart from the fact that it's run by Bill Pulte and it gives him access to this data, I didn't really think they were really in charge of like policing this, And so
like what you checked the securitization documents that her like mortgage got sliced into in the MBSs, and then you went out and found, like this is get out of here.
It's very, very strange. So that was kind of
crime corner. That's crime
corner. Macroeconomic analysis corner with Alex and Kiah, Bank Nerd Corner. Kiah, final topic, and you haven't managed to dodge it because we still have a little time, is a question I've wanted to ask you for the last couple episodes, and I'm going to ask you right now. Kiah, what are tokenized deposits and what are they good for?
Okay. This topic kind of makes me have a lot of emotional reactions and responses before I can intellectually engage with it. It makes me feel like I don't know what banks are and do. It makes me everything I've learned up to this point was a lie. Yeah. It also makes me feel like old man yells at clouds.
Sure.
Because
not a position Kiah Haslett likes to be put in, but she will do it if she needs to.
Have I misunderstood the nature of money? Is money a tangible thing that I hold in my hands and pass to someone else? And tokenized money is like something else? Like do I not live in a world where my money is digital? And so when I open my bank account every day to reconcile my YNABs, that's an electronic representation of my money. It's
you
not
could
my
call
money.
it a token of your money, maybe.
Yeah, but it's not a token somehow. Somehow that's not a token. It's just representations. Okay, so I had to look up an essay written by your other co-host, Simon Taylor,
yes,
to explain what a tokenized deposit is. And I understand these things as words. So a tokenized deposit is on-chain representation of a dollar that is 100% backed by bank deposits. Okay. So it's like, do you remember the idea of a plan? It's the idea of a deposit, I guess.
Okay.
And so the money is in your bank account, but then there's a twin of your money that lives on a chain. And when I say a chain, I don't mean the US banking system. I don't mean FedRails. I mean Ethereum, Solana, and Base. And so I could take my deposit and I can twin it. So I don't have double the amount of money. I just have, it's like the soul of my money has left my money and then is moving around in the world.
Like astral projection of money.
Yeah. And then I can pay people that are on chains. Okay. And I can do that fast. And I can do that, I guess. Guys, I've never had a problem sending money. I'm sure some people have problems sending money. I've never had a problem figuring out how to give someone money. And it's never been like, oh man, I sent the money and then it didn't get there and then they got there. But I guess on chain, you can send money anywhere and it's fast. And then it's because I sent them not my money, I sent them the token of my money, and then they take the token of my money, and then they put that token into their token account. And if they want to move it off chain, I guess that's when the money's actually debited, ? So I had to learn all this, but then was thinking while I was learning it, okay, so tokenized deposits, it all comes back to payments, right? You want to tokenize deposits so you can send them to someone else faster who isn't at your bank or isn't at your payment loop, right? Sure. Question 2. Do all banks need to tokenize their deposits for us to interact with each other? Or can just one party have a tokenized account? And if so, is it the sending party or the receiving party? Can I tokenize my deposit and then send it to you if you're not on chain? Because then I've just created a bigger closed net loop, right? The closed loop can be the world. It doesn't have to just be US banks. It can be global banks. But it's still we still kind of have to still be on the same chain, right? Maybe? Or you can move across chains, maybe bridges to chains. And then question 3, does this increase or decrease the potential for bank customers being scammed? Because isn't it now easier for me to directly give my money to a scammer in Malaysia? Versus me having to take my Chase account and then put it in Circle and then buy USDT and then send it across on stable coins and then to their wallet and then they unchain it, right? So cool. I just cut out a bunch of middlemans in my fraud or my scam so that I could send that money faster. And that solved none of my problems. And in fact, probably made my problem a little worse. Question 4, when is a bank deposit considered to have left the system? When does it leave then? Because if I'm tokenizing my money, if I'm tokenizing my JP Morgan deposit and sending it to you, and you're sending it, I don't know, to your Tether account, question mark. When does it leave JP Morgan's? Is the chain, is on chain part of the system? And then finally, in conclusion, I think closed networks are fine. Having learned all that, I feel very comfortable with the banking system that I use. And I just can't. This is what me and crypto is. And this is, you asked for this. You made me do this. I feel I left my house. I walked all the way around and then I came back to my house and it was fine. And I'm no better or no worse for this.
Oh my God, this is amazing. I'm so glad I made you do this. Okay. I don't think I
anyone, and I didn't help myself. And also, really importantly, I still don't think I understand it. Like, I think I just said a bunch of things that like indicated where I'm having issues, and I just am like, this can't be it. This can't be. You can't tell me this is helping anything, and this is something banks need to care about, because I just don't. This can't be it.
Okay, well, that was great. That was like when a screenwriter knows that they're like writing a movie for a really great actor, and they don't even really need to like write all the things. They just need to like put them in the situation, and the actor's just going to do a soliloquy, and it's going to be amazing. That was what just happened. So that was amazing.
I can't believe you made me do that.
Oh, it was the best.
I feel so vulnerable.
We're going to cut that as like a clip and put it on YouTube. That was incredible. So, okay. Deconstructing that a little bit. I think you asked actually very good questions about tokenized deposits. We haven't even gotten to the second part of my question, which is like, why stablecoins versus tokenized deposits? I won't even force you to go down.
I can't.
I won't even force you to do that. But it is interesting to me because despite having said everything you said, which again, like a lot of truth there, I think you're asking exactly the right questions. Despite that, if you listen to like bank earning calls, or you read the trades on what banks are talking about or what they're being asked about on earnings calls, they're talking about tokenized deposits, Kiah. Chase has a pilot tokenized deposit product. I think they're working with Base, which is Coinbase's blockchain built on top of Ethereum. And, Citi has talked about doing tokenized deposits. So like this is being discussed. And as near as I can figure, and I'm with you in terms of like being at the very beginning of my understanding of this, the basic idea is something to the effect of, if there is any value in money being on chain, and I circle the word "if" 5 times in permanent marker. If there is value in money being on chain, then it is better for banks and possibly for customers for that money that is on chain to be bank deposits, rather than other forms of money on chain. So
yes,
just to explore that idea for one sec.
I think it's useful to be like, to think of, and I have to learn about this because of stupid national trust charters.
You have to.
But is the money insured? Does the money qualify for deposit insurance?
That's just it, right? So like, if my understanding, and we're learning together. This is learning in public, but this is learning while just laughing a tremendous amount. If they are just deposits that are ledgered differently using blockchain technology, I suppose you could say, then fundamentally they are treated as deposits by a bank. They are insured deposits if they are under 250,000. They are deposits that the bank can lend against.
Yep.
They are deposits that are looked at from a risk perspective, the way that all other deposits are, in terms of liquidity risk, duration risk, all of the interest rate risk, all the things that we talk about on this show. Now, having said that, there's 2 components there that I think are interesting. One is, and you talk about this is like your thing. The nature of deposits is not all the same. Not all bank deposits are the same.
Right. Sticky and hot.
Sticky, hot, brokered, non-brokered, blah, 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 commercial, consumer, blah, 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 blah. I could imagine a future world in which some deposits are on-chain, and the FDIC has to grapple with the question, what is the nature of these deposits? And is that nature different than other deposits that are not on-chain? That would be a question. The other question, circling back around to our thing that we circled multiple times, is if. And that is the one that, as you went into your little spiral there, that I think is causing you and many other people's brains to short out, including myself, which is, what is the if? Why would it be valuable for the money to be on-chain? And you can think about the nature of blockchains as a potential answer to that question, and thinking about trying to back into use cases. Blockchain ledgers operate 24/7. They don't have holidays. They're not closed. Now, you could say the same thing about FedNow. So like that maybe isn't as relevant as a value proposition as it used to be, but you could say that. Blockchains theoretically can work across borders, setting aside any money laundering concerns that anyone might have. That might make it easier for certain use cases. And then the third one, and this actually ties most directly, I think, to where Chase's brain is at and where Citi's brain is at and others, is it can also be used to create a great deal of like shared visibility into what's happening with payments or with money being stored in various places. And that to me is where like the commercial treasury B2B payments type stuff enters in. And from what I understand of what Chase is doing and what Citi is doing, they're looking at it as, hey, if we have a bunch of commercial customers that all interact with each other and they're all parties and counterparties with each other and they're sending money back and forth, very large amounts of money, is there any value in using blockchain as the ledger to manage those payments between those trusted parties and counterparties?
Yeah.
Now, is that decentralization? Not really. Is that something where money can just be sent anywhere permissionless? No, not really. Is it slightly more efficient as a technology solution than the other ways that Chase or Citi might manage those large-scale B2B payments and treasury management functions? Maybe? Question mark. And so, like, to me, that's how you start to unpack that question about where the value is and like what if this is valuable. But to me, that still seems very speculative.
Yeah.
And to the extent that Chase is experimenting with this, it's just because they have billions of dollars and they don't know what to do with it. So we might as well do this thing. To the extent that others in the ecosystem are talking about it on the banking side, it's probably because analysts are asking about it because everyone's very excited about this right now. And it sounds better to have a nice, confident, we're piloting this answer than a we don't know what the hell you're talking about answer. But I don't know. And I think your lack of certainty on this topic, in addition to being really fun to watch play out in real time, is, I think, the right general frame from a bank perspective to look at this.
I go back to Randy Quarles, who used to be the board chair, in 2021 said in a speech, and this was about CBDC, but he said, quote, "My first observation is that the general public already transacts mostly in digital dollars by sending and receiving electronic balances in our commercial bank accounts." And I kind of like, I feel like that's just the most reasonable way to view this. And so when we talk about like, I can't decide like how much of this is branding that like sounds innovative, which like having covered banks since 2011, I want you to know we have been here. We haven't been tokenized deposits, but we have been here before with blockchain and crypto. And maybe this time will actually take because the administration is so in favor of it. But it is interesting because I'm like, these use cases, did this use case not exist in 2024? Or it probably actually existed in 2015. It probably existed in 2020. And we just used existing channels. And so it's hard for me. I'm such a cynic sometimes. I'm not a futurist. I have very simple money transaction and transmission needs that I feel like if a payment is hard, it's hard for a reason. And that, going back to like, hey, do you remember how like Zelle, like the banks are getting sued by Zelle, making it too easy to send your money to a scammer? Is that like, have we taken any lessons from that and we're applying it to on-chain finance, or no, do we view these as separate things? So Simon's article address what a tokenized deposit is, but it did not address why you would need a tokenized deposit. And again, we have a lot of ways to transmit money, and maybe it's that money moves too slow, but that's just kind of how the world, I don't know, that's kind of how the world is. Like I don't know, like remember in Flash Boys, they were like moving all the servers, so they'd be like 1 second faster. And you're like, I don't know, man. For maybe some people, like that's where they're gonna win. But for most people, like you can just like you can have T2 or you can have T1, right?
Well, it's a great point. I mean, like this idea that like anything slow is bad by default, I think is bad logic and bad reasoning. Now, I mean, there are definitely examples where speed matters, right, to different parties. But like the other thing I've always found with that is, and this is really important in payments, actually, right? A core theory in payments, which is very true, I've found, is that one party in the transaction has more power than the other party. And thus, that party tends to get to dictate to the other one how the payment will happen, right? So this is why until Bilt changed this equation, you couldn't pay your mortgage with a credit card because the mortgage servicer had the power and you, the customer, did not have the power. This is why, when you go to a car dealership, they wouldn't take a credit card.
Yeah.
And they probably didn't want you to pay in cash. They wanted a check from your bank, not even from you, but from your bank. Like there are very specific dynamics in payments that have more to do with the sort of power dynamics between the providers than it does the technology limitations, right? Just because you can pay in real time doesn't mean that everyone on each side of the transaction is always going to want to, or is going to be able to force the other side of the transaction to do that. I will say, going back to your earlier point about sort of why now and what's going on here, I will say that like one of the things I've noticed about the crypto ecosystem is that there will be people who sort of jump in and out of this stuff based on what's sort of trending at the moment, right? Yeah. So like, hey,
not true believers.
All of our, not really so much. Like all of our stock market analysts are asking us about X. And so we need to do this. And then, hey, you know what? The OCC said we're not allowed to do this anymore, or it's going to be too risky for us to do this. So now we're not going to do that anymore. Like they just kind of come and go based on the way the wind is blowing. By contrast, I'm looking at a press release now as we talk from, this is 2021, so the halcyon days of all of this stuff. And it was Customers Bank and Tacit launched blockchain-enabled instant payments on Tacit Pay, right? Yep. And this is kind of like the use case I was describing before, where it's for B2B payments, market making, trading operations, real estate, manufacturing, logistics. So like a very sort of obscure, high volume, high dollar amount corner of the payments ecosystem where, and I don't know the details of how it's worked or how well it's gone, but like that's an example to me of one where, this idea is not brand new. I don't know that they were calling it tokenized deposits back then. I think they were calling it something else. Yeah. But like there is, with a lot of this stuff, there is like a theoretical there. It's just that the thing that makes crypto so hard for me to cover is it's always vacillating between extreme hype and extreme like deficit of hype. And it makes it really hard to pick out what's real and what's not. Even when you're listening to the CEO of Citi on an earnings call talking about tokenized deposits, I can't tell if she's speaking about reality or about sort of the perception of reality.
Yeah. And, thinking about, I hate to be like this, but like Citi and JP Morgan, they can maybe do this, and Versa Bank can do it, and there's maybe a couple of banks, Customers Bank can do it.
Sure.
Many banks haven't solved their other payments problems, which they might need to solve first.
That's what I keep talking to banks about when they ask me about like stable coins or tokenized deposits. I'm like, if you're in a position where this is your biggest problem, you are in a great spot as a community bank.
Right. And
but so it's unlikely you're in that spot.
And I always joke that if I'll talk about stablecoins if it makes community banks take their payments problems seriously. Like I feel like my impression is that small business banking is very difficult for many community and mid-sized banks. They don't have a really good suite of products and services. Mm-hmm. And that includes payments. And I always go back to like, why does Square, the like payments dongle, exist? Like, why did Square have to make that and make it so that vendors could accept these like card payments for small dollars? Yeah. I guess there was just something about merchant acquisition and processing and payments that like just wasn't resonating with the market, or there wasn't getting the penetration. And
and Jamie Dimon has talked about that, right? Like I think he said on the record when talking about this, like, why didn't we invent Square?
I ask myself that all the time.
It's a great question. Yeah, no, it's a really great question. And again, it's like the thing that makes this really hard is sometimes it's like, well, we didn't invent this because the thing we have is good enough. And this thing that's now being pushed is more being pushed because of the incentives of others, not because customers are demanding it. But I think Square is a good counterexample where it's like, to answer Jamie Dimon's question, why didn't we invent Square? Because you were fine not serving micro merchants.
Yeah,
like you didn't see an opportunity
you
there.
didn't think
You
it
were
was a
making
problem.
plenty of money. Yeah, like you were. It wasn't on your radar as an urgent customer problem. But for those micro merchants, it was an urgent problem.
Right.
And the standard merchant acquiring approach with ISOs, hooking up credit card terminals out of the back of their car, like that model didn't work for someone selling flowers at a farmer's market, one weekend a month. And so I think that it is really difficult to tell where customer need is pulling these things versus when it's being pushed. And I don't know in my 20 years if I've come across a area of technology where it's harder to discern the difference between those two things than crypto and now stablecoins.
I'm skipping myself a little bit. I don't know when this episode will come out versus when this story will come out, but I spoke with the ICBA this week about national trust charters and their opposition to national trust charters. And one of the things I asked was like, oh, so why is the ICBA against this? And they were like, because we think these are risky and they will hurt consumers because they look like regular banks. They actually have bank in the name. They have a certain type of bank charter. So it can be very confusing if they run into problems. And I was like, well, many of these banks that are going to apply for a national trust charter are not going to have insured deposits. So it seems like this won't be really a consumer issue. And so hopefully if someone puts their money at a trust,
they're sophisticated
they're not supposed
who knows.
Yeah, but also like the trust isn't supposed to lend. So like when you say you're concerned about a run, are you implying that the trust, that Anchorage is lending illegally with customer assets and which are not deposits? And so like how would a run happen at a trust? And they're like, well, the reserve, they were like saying like the reserve might break. And I was like, okay, well, so like a 10% discount, like we're not engaged. They're not engaged in money. And like, I was going like, genuinely, what are you worried about? What are you worried about? And they were like, well, we also just don't think these companies really invest in their local community because they're not taking deposits and lending them in the community. And I was like, okay, so are you worried that maturity transformation won't happen? Because and then my final question was like, well, if I'm a customer that thinks that Anchorage can serve me better than my local bank for X, Y, and Z reasons, and that like as part of that, I should put my assets in a trust at Anchorage, and then I can do whatever at Anchorage. Like, isn't the community bank right to lose my business? The community bank, I'm not their customer anymore, right? I just kind of kept being like, I'm trying to get them to say like, we just don't want and then I was like, oh, also, why do we need 4,000 community banks, but you don't want these types of banks? Why do we need more de novo banks, but we don't want trust? And it was really interesting to be like, like thinking a little bit about a bank who has to care about tokenized deposits. Like, what problem are you solving for this customer? How is that customer solving this problem already? And also, like, if your customer really, really needs tokenized deposits and you, like, maybe that's not the right customer for you anymore, right? And I just, like, I really kind of struggle with some of these, like, who needs to be offering this product? Who needs to kind of solve this problem? What is this problem that we're actually solving? And how is it getting solved in the meantime? Like, do we need, like, the Square but for tokenized deposits? Like, is that what we're reacting to, that we missed out on Square and small dollar vendor payments? And so now we have to solve for tokenized deposits. And I just don't think I don't think that that's the right response.
Well, and it is, just to add one note on the ICBA thing, it is really weird how you can say at the same time, we're not going to do this because we don't think our customers want it, but we don't think these other parties should be allowed to offer it too. It's like, okay, like one of those two things can't be true. Like either they shouldn't be allowed to offer it because we don't want the competition, but like we're going to go do this, so don't worry about it. Or it should be, people aren't going to want this, so we're not going to do it. But if other parties want to try to do it, they can, because our read of the market is great. Right. But like, it's strangely without agency to say, both we're not going to do this, but also no one else should be allowed to do this either, unless you can tell me why it poses a grave risk to safety and soundness. And that's where some of the community bank arguments on this stuff kind of fall flat with me, where it's like, well, they won't lend into communities anymore. And it's like, okay, that's a tough one though, because like, a lot of the loans you make are large commercial loans. It's not like you're only loaning money to small businesses. So like, is that really something that we're going to miss if we don't do that? Or, hey, they might break their reserve and break the buck.
It was so funny.
For like a day before it goes back and people get all the money back. Like, it's being held in treasuries. Like, it's not like the money's not going to be there. I don't understand.
I also spiraled a little bit during that interview, because I was thinking, like, what if Circle had put its $10 billion, not at SVB, but at like Anchorage, right? Anchorage, it was in operation when SVB fails.
Yeah.
What if Circle took losses, right? And I was thinking a little bit about, like, if you think national trust charters, or you think these things like pose risks to the financial services space, isn't it better to take that out of banks, insured depositories, and put it into uninsured depositories? And we know, like, it's interesting that there would be opposition to national trust charters as uninsured depositories posing risk, when, like, I don't know, we have like all these like BaaS fintechs, and those are outside of it.
Like, who's the risk to, right? Is kind of the question. I mean, I will say, and then we can wrap up here, but I do think that the idea that trust charters can actually reach end sort of quote unquote regular consumers, I do think there is a little bit something there, just because of the nature of stablecoins being to sort of act functionally as deposits and a payment mechanism. And so I do think a little bit about, like, if money stored in a trust account historically was money set aside, where the money that is represented by the dollars in that trust account, it can't go anywhere, it can't do anything. It literally just sits there. And then obviously the company that's holding it on your behalf isn't supposed to do anything novel or interesting with it. They're just supposed to hang on to it. With stable coins, the thing that's interesting to me about that is the dollars are going to sit in a trust account, and again, theoretically, the entity holding it isn't going to do anything novel with the money, but the customer is, because they're going to have stable coins, and they'll go out and do things with their stable coins that will create potential, like, consumer protection, harm, risk type things. So, like, it does seem like a bit of a novel use of the trust charter in that way, but I'm scooping your story, which you're gonna answer all these questions for us.
I'm gonna answer none of them. I'm literally just gonna be like, here's a bunch of letters that were published in 2021, and also here is the one bank that has a national trust charter that does digital stuff, and then here is the bank. Here's one of the groups that is against them, and here are their arguments, and here's kind of where I see, like, weakness and strength in the arguments. But it's just
clarity. We're going to get so much clarity when you weigh in on this.
The other thing too is, like, God, people can just do dumb stuff with their money. Like, it's not
totally. That's like, true.
Remember, the rules scope in some stuff and they leave out some stuff. And
Aspiration can pay Kawhi Leonard $50 million to do nothing. Like, that's their choice.
And if it was, a tokenized deposit that moved through Aspiration on chain and then moved into his wallet, like, that's fine.
I didn't even think of that. That's a totally other angle. That's a good follow-up piece to the piece I recently published on the story. Kiah, I'm not even going to make you rant about something, because we already, I think, did that on the pod at least a couple of times there. Yeah, we did, and it was great. Thank you. This was wonderful, and we will pick it up again next month. Looking forward to seeing you in person soon.
Yep, see you soon.